Hello, you've reached the first lesson of the second module. Well done! In today's lesson you will learn the crucial difference between price and value. We touched upon this briefly in earlier lessons, but since exploiting differences between price and value is the cornerstone of value investing, it is worth exploring in more detail. Also, we'll cover 3 types of value and how to differentiate between them. Let's go! The title of this lesson is based on a passage from Warren Buffett's letters to his shareholders in 2008. Price is what you pay, value is what you get. This is the most concise, clear way I ever heard someone explain this concept. Think about it. If a brick is normally priced at $1 and is priced at $1.20 the next day, what does this say about the quality of the brick? That's right, absolutely nothing. The brick is still exactly the same as the day before. All that has changed is the amount of money you have to pay for it. In other words, you still get the same value, a brick, for a higher price. Price is what you pay, value is what you get. There are 3 types of value though: relative value, absolute value, and perceived value. Let's quickly look at them individually, because it is important to understand the differences. Relative value shows you what something is worth compared to something else. For example, what a product or company is worth compared to its competitors. So if a certain type of brick costs $2 in store A and the same type of brick costs $4 in store B, the bricks in store A are relatively cheap. They offer a higher relative value because you get more bricks per dollar you spend compared to the bricks in store B. For companies trading on the stock market, the same logic applies. If 2 companies operate in the same market, let's say they both sell stringless guitars, we can compare them to see which company is cheap relative to its competitor, just as in the example with the bricks. However, it is very important to realize that if a company is cheap relative to its competitors in the same industry, this does not automatically mean that they are trading at an attractive price. Imagine that the bricks in our example are really worth only $1. In this case, store A offers better value for money, but their bricks are still way overpriced. So one expensive thing might be slightly cheaper than another expensive thing, but in the end they are both expensive, and value investors don't want expensive, they like cheap stuff. Therefore it is crucial to look at the absolute value rather than relative value. Absolute value is what something is worth based on its intrinsic features. For example, what an entire company is realistically worth based on how the company performs and all the things it owns, like buildings, machines, and cash. In Lesson 8 we will describe several methods to estimate the absolute value of a company, but for now it is sufficient to understand that absolute value shows what a company is realistically worth based on what it owns and how it performs, while relative value only indicates whether one company is cheaper or more expensive than another company, without saying anything about whether these companies are cheap or expensive in their own right. For value investors, relative value is important, but not by comparing 2 or more companies, but by comparing the stock price of a company relative to the absolute value of that same company. This is the only way to determine whether a company is cheap or expensive. A company is cheap or undervalued when the stock price is lower than the absolute value of the underlying company. On the other hand, a company is expensive or overvalued when the stock price is higher than the absolute value of the underlying company. Now, the final type of value is perceived value. This is a dangerous one. Perceived value is the value which people assign to something in their minds. It is intangible. This perceived value can be completely unrelated to the absolute value we just discussed. Take for example a perfume bottle. It might cost only a few dollars to produce a bottle of perfume, which means the absolute value is rather low. But because perfume is marketed as a luxury product, consumers perceive the value of a bottle to be much higher than the actual production costs and are therefore willing to pay serious money for it. In other words, Perceived value affects the price that people are willing to pay for something. This also happens on the stock market. Only the marketing is replaced by financial news and analyst recommendations. Seth Klarman said the following about this. Security prices reflect investors' perception of reality and not necessarily reality itself. Let's take for example the dot-com bubble of 2000. During that period, the perceived value of technology companies was at an all-time high. Investors were willing to pay ridiculous prices for companies which were worthless from an absolute value standpoint. You all know how this turned out. The stock market crashed once investors started realizing that their investments were based on hype, hope, and a whole lot of nothing. A disciplined focus on absolute value is ultimately the only protection against situations like these. To solidify your understanding about the difference between price and value, let me give you one more quick example. Let's say you want to sell your couch on eBay, because you are planning to buy a new one. You set a price, and if someone offers you that price, the buyer will receive your couch. Simple. However, it does not matter if you ask $100 or $1,000 for it. The couch remains exactly the same. If you convince people it is a rare designer couch, you would increase the perceived value. But again, the couch remains exactly the same, no matter what price you ask for it. On the stock market, the same applies. No matter what the price of a stock is, the underlying company remains the same. So focus on the value of the company, not on its stock price. Price only matters relative to the value of the company. It should be clear by now that price and value are different and are often unrelated to each other. However, this only applies in the short run. In the short run, stock prices are unpredictable, but in the long run, they are loosely tied to the performance and value of the underlying company. So if you buy a company at a cheap price, which is way below the absolute value of the company, you cannot predict when the stock price will rise, but you can be fairly certain that eventually the price will equal value. Patience is the key here. Buffett's famous quote says, "In the short run, the market is a voting machine, but in the long run, the market is a weighing machine." Let us end this lesson with a story about Mr. Market. Mr. Market is a fictitious character described by the father of value investing, Benjamin Graham, in his influential book The Intelligent Investor. This metaphor for the stock market will radically change the way you look at investing. The story is this. Every single day, a guy named Mr. Market comes to your house and offers you stocks for a certain price. You then have the option to buy, sell, or do nothing. It doesn't matter to Mr. Market what you decide to do, because he will be back with a new quote the next day anyway. However, Mr. Market is a manic depressive guy. When he is in a good mood, he gets greedy and quotes ridiculously high prices. But when he is feeling depressed and fearful, he is willing to sell you the same stocks for rock bottom prices. What Benjamin Graham tried to point out with this metaphor is that the price of a stock is primarily determined by emotions rather than facts. The prices Mr. Market quotes you on a daily basis therefore say little about how well the underlying company is actually performing. He does not offer you guidance. He simply pitches opportunities, and then you can decide whether to act on it or not. So how can you apply this to your own investment strategy? Well, Graham teaches us to profit from market folly rather than to participate in it. You can take advantage of Mr. Market's manic depression by buying stocks when he is depressed and selling to him when he is manic and optimistic. If the prices that Mr. Market quotes are unattractive, just sit still and wait for a better offer. He'll be back tomorrow. But is this Mr. Market metaphor still valid in today's world? Warren Buffett thinks it is. Ben's Mr. Market allegory may seem out of date in today's investment world, in which most professionals and academicians talk of efficient markets, dynamic hedging, and betas. Their interest in such matters is understandable, since techniques shrouded in mystery clearly have value to the purveyor of investment advice. After all, what witch doctor has ever achieved fame and fortune by simply advising, "Take 2 aspirins"? So, to summarize, price is what you pay, value is what you get. There are 3 types of value: relative, absolute, and perceived value. Relative value examines what a company is worth compared to its competitors. Absolute value examines what a company is realistically worth based on its performance and the things it owns. Perceived value is the value people assign to something in their head. Stock prices reflect investors' perception of reality, not necessarily reality itself. In the short run, a stock price says nothing about the value of the underlying company. In the long run, stock prices will eventually reflect the absolute value of a company. Benjamin Graham's Mr. Market's metaphor is a great way to think about investing and still applies in today's world. I'm guessing you've taken a lot of notes during this lesson because we covered a lot. In today's lesson, we briefly touched upon the fact that stock prices can significantly diverge from absolute value in the short run. The next lesson will explore in detail why this happens, how our mind sometimes works against us, and how all of this causes stock market bubbles.